Tesla is set to expand its production capacity at its facilities across the world, and in some way, improve the delivery of its cars. After trading at multiples over its revenue and earnings for years, some Tesla analysts like Meet Kevin believe that the car company is now getting into the range of a value stock. Hey guys, welcome back to Everything Tesla Stock. Over the years, Tesla has evolved into a dynamic technology innovator and has transformed the EV space almost the same way Amazon changed the retail landscape and Netflix revolutionized entertainment. The automaker, although not quite as big as some automotive companies like Volkswagen, is beginning to find its way up the ladder and is soon to not only lead the EV industry, but also the automotive industry at large. Tesla is the market leader in battery-powered electric car sales in the United States, with roughly 70% market share. The company's flagship Model 3 is the best-selling EV model in the United States, and its other car models are also doing incredibly well in its different markets. So, is Tesla a value stock? Let's find out, but before we do, don't forget to like and subscribe, and turn on that notification button to keep up to date on everything going on with Tesla. Popular YouTuber and Tesla bull Meet Kevin recently said that Tesla is almost starting to look like a value stock, even though it might not actually be one. According to the Tesla bull, value stocks are expected to experience an increase in earnings per share over the next 6 months on average, while growth stocks are expected to have an EPS decline within the same time frame. According to Forbes, value stocks are stocks of companies that investors believe are underpriced based on the performance of their underlying businesses. Shares of such companies appear to trade at a lower price relative to their fundamentals, such as dividends, earnings, or sales, making them appear to value investors. These stocks trade at levels that are perceived to be below their fundamentals, and typically have a bargain price as investors see the company as unfavorable in the marketplace. On the other hand, growth stocks are usually considerably more volatile, higher risk stocks that have the potential for significant near-term upside. These are stocks of companies that are generating above average growth in sales and profits, and have the potential to outperform over time as their businesses expand. They may appear overpriced based on their current businesses, but they are expected to grow into and even exceed their current valuations in the future. While growth stocks like Amazon, Google, Facebook, and Microsoft are currently suffering from declining EPS, Tesla, on the other hand, is expected to see an increase in EPS in the coming months. And so, since there is a massive EPS gain for Tesla, why is the stock underperforming so much? We're going to get to that in a minute, but before we do, here's a good way to keep your personal data safe. This part of the video is sponsored by Aura. In today's ever-expanding internet space, your data isn't always so safe, as personal and sensitive information can easily be compromised. Identity theft is now the fastest-growing crime in America. In 2020, over 49 million Americans were victims to identity theft, costing them a total of $56 billion. This is why we're excited to partner with Aura, who's the sponsor of this video and the official digital security sponsor of the Minnesota Timberwolves. Aura is the #1 identity theft and financial fraud security provider. It's also a VPN and a password management and antivirus software. Aura monitors the internet and the dark web and alerts you if any of your passwords and accounts have been breached. You can also set spending alerts to get notified of any suspicious transactions or credit card operations. You can try Aura for free for 2 weeks today with no obligations. Start your 14-day free trial at aura.com/Tesla. When you try Aura by using the link in the description below, also know that you're supporting this small YouTube channel and helping us pay for the production of these videos. It's greatly appreciated. Thank you. Now, let's get back to today's video. Tesla stock is down over 30% since August. In comparison, the Nasdaq is down only 8% over the same period. Shares of the EV maker have also been on a downtrend for quite some time, and many Tesla investors believe that this drop is because Elon Musk recently sold more Tesla shares, even after he said he was done selling. In the last 12 months, Musk has collectively sold over $37.5 billion of Tesla shares, and this is starting to create a situation where, for the first time, Tesla seems concerned about its stock price, which is important since the automaker somehow needs to increase its orders and raise more capital. However, while this could be a tough trading time, Meet Kevin still sees the dip as a buying opportunity for investors in the long term. Several analysts propose a stock buyback to redeem the stock value, and luckily, Tesla's board has confirmed talks about starting a stock buyback program worth between $5 and $10 billion. This would very likely help the stock, even though it is hard to say by how much. However, while these are valid factors to consider, it is very important to note that Musk may have sold shares even without the Twitter deal, and so the sales might not entirely be the reason why Tesla's stock price is dropping. Likewise, demand may not be a problem, and Tesla investors might not even see this as an issue. According to Meet Kevin, falling lead times for Tesla cars is creating fear of falling demand. However, the upshot is that as long as Tesla can sell every car they make, which is something Musk suggests is certain, Tesla can use this recession to substantially gain market share as other EVs and legacy automakers lag. Kevin added that this means more revenues for Tesla from FSD, solar, batteries, and also the network effect of more people driving Tesla, which will lead to more people buying Tesla cars. The Tesla bull further stated that he has a personal price target of $546 for Tesla by 2025. This is about 42% compounded returns each year for 3 years. One other factor that is causing investors to fear a demand issue is the drop in Tesla's delivery backlogs. However, rather than a demand crash, it could also be that Tesla's car supply is way more than demand, which is causing the backlog to drop. And even if there is a demand problem because of the price of EVs, Tesla can afford to lower prices and still make enormous profits. The only actual threat to Tesla's demand may be when a terrible recession comes, where people are unable to buy EVs and are cost conscientious. Therefore, one way by which Tesla can most definitely increase its demand is to produce its low-cost car. Tesla is working towards a next-generation electric car platform that will be half the price of the Model 3 and Model Y platform. But if this really is coming, then Tesla could wait until they are close to delivery before making an announcement for this car. Tesla is only just starting to get into autonomy, and it's still got loads of room to grow. In a recent tweet, Meet Kevin cited that in Q2, Tesla made $16,669 per car in gross profit by selling only electric vehicles, while its American competitor Ford made only about $5,400 per car in gross profit in that same period from selling only gas cars, and even lost money on EV sales. This shows that Tesla was about 3 times higher than Ford in terms of profit for that quarter. However, while Tesla may be viewed as a value stock right now, value stocks are not always good investments in the end. Unfortunately, many cheap stocks are cheap for good reason, and so a low PE ratio does not necessarily make a stock an attractive value investing opportunity. Companies with slow or even negative revenue growth, shrinking margins, high debt levels, or companies operating in markets that are in secular decline may often seem like value stocks at a first glance, but turn out to be bad value traps in the end, since they can sometimes trap value investors into a bad investment. But overall, Tesla still proves to be a good investment, and the automaker has managed to garner the reputation of a gold standard over the years and is now far bigger than it was when it started at its initial public offering in 2010, with its market cap crossing $1 trillion for the first time in October of last year. Tesla's market capitalization is now more than the combined value of legacy automakers including Toyota, Volkswagen, Daimler, GM, and Ford. So, rather than focusing on the factors that may bring Tesla down in the future, it's better to focus on the core EV business, which remains strong for Tesla, and for which the car company is expected to get stronger in the coming years, especially in the US after regaining access to the federal EV tax credit. Just like Meet Kevin, several Tesla bulls have maintained their price targets for Tesla stock. Morgan Stanley analyst Adam Jones recently reiterated its buy rating for Tesla, with a $330 price target, which represents a significant upside over Tesla's current stock price. Even in a case of a serious recession, Tesla is well positioned to scale through, so investors may want to focus on Tesla's fundamentals and not pay too much attention to the distractions. Do you think Tesla can be regarded as a value stock? Let us know down below, and if you want to know more about what Tesla's been up to in the last few days, go ahead and click on this next video on your screen. See you there.